I was somewhat taken aback by the intensity of the year-over-year CPI numbers, 2.9 on headline, 2.3 on core, but the market certainly seemed to have dozed through it. But there are plenty of reasons for that. What were your thoughts on CPI and market reaction?
Well, I think that we're getting closer to the peak of inflation in this cycle. Just looking at some of the year-over-year comparables, this may start to run out of steam by the end of August, possibly September. And I also think that core PCE running at 2% last data set around might actually struggle to hold on to that once we look into the guts of the number. Core PCE may dip down to about 1.9. So I think that's what the market's focusing on right now.
All right, the big elephant in the room, every conversation seriously for months and on this floor for years, the flattening yield curve. So I want a very logistic question from the vantage point of Jay Powell and company. How difficult is it going to be for the Fed to, try to put a positive spin on any inversions, early inversions on the curve, considering they're still talking 2 more tightenings?
Right. So here's the story. So we care about the yield curve right now being flat, but we're not overly worried about it. And I think this is partially what the Fed is going to start to tell us, is that some of the manipulation that's come through with quantitative easing has pushed down the yield curve, has flattened the yield curve, has done what we call reducing the term premia. What we have estimated is that the curve is about 40 basis points flatter than it otherwise ordinarily would be right now due to QE. So if the yield curve today is about 30 basis points, add 40 to that. If we control for QE and adjust for it, account for it, it would be more like 70 basis points in normal historical terms. That's what the Fed's going to tell us. The market reaction, though, I think once you start to get to a flat yield curve, which I do believe we are going to get to by sometime the beginning of 2019, it could be flat to inverted. I think the markets are going to be a little bit more concerned about that, and it could create a little bit of volatility around it. But I still think that we have to be very respectful of what QE has done to the curve, and it's flattened it more than what it ordinarily would be right now. So we have to take it with a little bit of a grain of salt.
Listen, you're preaching to the choir down here with that logic. We've had it on trading floors for a long time. But it's still difficult to teach investors to look at something that they've almost been conditioned to believe ends up in a certain scenario. So having said that, our last few seconds here, is it possible that Jay Powell and company would quicken balance sheet reduction from its current pace it's supposed to reach in October to roughly $50 billion a month? Final thought.
I think it's going to be hard for them to do that because of bank reserves. Bank reserves may not be able to fall as much as what we had thought that they would. So if they sped the pace up of balance sheet runoff, I think that could be more disruptive. Maybe a better solution is that they just don't hike rates as fast, and that could re-steepen the yield curve and really let these inflation powers really start to quicken into the marketplace so we get some shape to the yield curve again, and I don't really see anything wrong with that.
So it's the least of 2 fears. If they go slow and inflation ramps up, that might cause a bigger scare in the markets than an inverted curve that doesn't mean what it once did.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.